If your household income drops from $90,000 to $70,000 by renewal time, a lender could tell you that you now only qualify for about $450,000 of mortgage instead of $600,000, even with a perfect payment record. That $150,000 gap comes purely from the federal stress test, not from anything you did wrong. I read the fine print so you don't have to. Stick around because I'm going to walk 3 real income situations through the exact maths so you can find the one closest to yours. Here's the decision we're modeling. At renewal, if you want to switch to a cheaper lender, you have to requalify at Canada's minimum qualifying rate. The greater of 5.25% or your contract rate plus 2% per OSFI's stress test framework. We'll run 3 household incomes through a 39% gross debt service cap over a 25-year amortization to see how much mortgage each one supports. The point is to show exactly where a lower income traps you with your current lender. Let's start with the baseline. A household still earning the $90,000 they originally qualified on, with no other debt. Applying a 39% gross debt service cap to $7,500 of monthly gross income gives a maximum housing payment of about $2,125 per month, per the standard affordability rules referenced by major banks. That's the number we test against the qualifying rate. Running that $2,125 monthly payment against a 5.25% qualifying rate over 25 years supports roughly $600,000 of mortgage, assuming minimal property tax and heating. This is illustrative, based on the stress test rates published by OSFI and used by major lenders. At this income, the household clears the test comfortably and can shop any lender it likes. At $90,000, the same payment represents only about 32 to 33% of gross income, well inside standard guidelines. That means this household passes the stress test with multiple lenders and keeps full negotiating power at renewal. Nothing here traps them. Now watch what happens when the income falls. Now meet Lisa, 42, in the Toronto area, whose household income fell from $90,000 to $70,000 after her partner cut back hours. Her payment history is perfect, and her actual mortgage is a 5-year fixed at 2.49%. But at renewal, if she wants to switch lenders, she's retested at today's rules on her new lower income of $5,933 per month. A 39% cap on $5,933 of monthly income gives a maximum housing payment of about $2,275, a 22% drop in allowable payment. At the same 5.25% qualifying rate, that supports roughly $450,000 of mortgage. That's a $150,000 reduction in qualified amount purely from the income change, based on the stress test rules referenced by major Canadian lenders. Lisa's remaining balance after 5 years is about $515,000, but her new income only qualifies her for $450,000 elsewhere. Her GDS climbs to roughly 41%, above the 39% cap most lenders apply when you switch, per published stress test policy. To move lenders, she'd need to pay down about $65,000 of principal first, money most households simply don't have lying around. If this is useful, subscribe. The next breakdown is already coming. Before I get to the last part, which is the most counterintuitive piece of this, here's why the income drop costs more than just borrowing power. Because Lisa can't pass the test with a competing lender, her current bank knows she has few options. Studies of Canadian lender pricing show banks often price renewals 0.25 to 0.50 points higher for clients who can't shop around. Let's put a number on that. On her $515,000 balance over 20 years, the best market rate of 4.25% would cost about $390 a month. Her existing lender's 4.75% offer costs about $307, roughly $115 more every month. Over the 5-year term, that's about $6,900, and over the full 20 years, the interest difference compounds to somewhere between $25,000 and $35,000. These figures are illustrative, based on the mid-20 to 20s rate spreads in the brief. This is the counterintuitive part, that $30,000 to $40,000 of extra interest doesn't buy Lisa one more square foot. It's purely the price of not being able to reshop her mortgage. The stress test didn't reject her because she couldn't afford her payment. It rejected her because her lower income failed the test elsewhere. That's the trap, and it's built into the rules. Line them up. At $90,000 income, the household qualifies for about $600,000 and shops freely. At $70,000, that qualified amount drops to about $450,000, while the actual balance sits at $515,000. So the household is stuck. And being stuck means a 4.75% renewal instead of 4.25%. costing $150 a month and up to $40,000 over the life of the loan. Same house, same payments, income the only difference. So which one are you? Run your current gross income through a major bank's affordability calculator that applies the 5.25% qualifying rate and compare the maximum against your remaining balance. If your qualified amount is below your balance and your GDS is creeping past 39%, you're in Lisa's situation and need a plan before renewal, not on renewal day. Next, I'm covering the exact 3 moves to protect your renewal when your income has dropped, including how a small principal paydown can flip you back over the qualifying line. If you want to catch that breakdown, subscribe so you don't miss it and you'll walk into your renewal knowing your number's cold.